So in our last class, we concluded our discussion around complex income tax, where we discussed the requirement for filing, filing of tax returns. Can you hear me, please? Can you hear me?
Yes, I can hear you, sir.
Okay, thank you. Filing of tax returns. We talked about payment of tax liability, where we said tax liability will be paid on total profits. We said on dividend. We said minimum tax. And we said on turnover. We discussed all this in our last class. And we said today we're going to look at past question and how to go about the solutions. That was the plan for today. Let's go. Before we look at past question, in the study pack I shared with you, I think there is a question there that we can look at. And someone will share that in our group. I don't have it. I found it. Okay, let's quickly look at question 20. Question 20 in your study pack. Someone should read it for us, please. Okay. Fortune Nigeria Limited, a reputable soap making company, is based in Lagos and registered over 10 years ago. The financial year end of the company is 31st December every year. The financial position of the company for the year ended 31st December 2023 was as follows. We are given turnover, cost of sales, gross profits, other income. We are given expenses, and you're now told that further relevant details are as follows. How do you attempt this kind of question? Now, the first thing you do when you see this kind of question is to see the approach to attempt it. Now, the examiner has asked you are required to compute the tax liability for the relevant year of assessment. Now, in doing that, the first thing you need to do is to analyze the additional information. Now, look at the first information that we have there. Included in the other income was a sum of 850,000 naira. Was a sum of 850,000. As
Please, what page is the question on?
you said?
The page the question is on.
Page 26 and 25. So 850 was earned as profit on disposal of fixed assets. So how do we treat profit on disposal of said this is not a taxable? What do we do? We deduct. That's number two. Salaries and wages included housing allowance of 10 senior management staff who were paid a sum of 200,000 naira each per annum. That is just for information's sake. You would have to pay your senior management allowance, and that is not a problem to the company. The company will take it up, and when the individual needs to be assessed with tax, they will charge them on tax on that, on their personal income tax. So it doesn't have any impact on company's income tax here.
So sorry, sir, please, what material? Because I can't seem to find the question.
Let me share it to the class. Are you on our WhatsApp group?
Yes, I am. Thank you, sir.
I just referred it to the material now. Can you see it?
Yes, thank you, sir.
Okay. Okay, we'll move on. We said again, 1/4 of the expense on rent was paid to the apartments occupied by the father of the managing director. What is that? That is or private expenses. In tax, this is not liable. So what is the implication of that? That means 1/4 of the rent will be disallowable. So the rent will be in the body of the question. You go and look for it. In this situation, it's 2001. Of that will be disallowed. That will be 525. Yes. I'm with you.
Please, sir, take the additional information. Please, sir, take the additional information too again, sir, please.
So that additional information number 2, I said it is just for information's sake. The reason is that company would have to pay allowance, and such an allowance will be deducted, will be a liable reduction. However, the individual that this allowance is paid to will pay personal income tax on it. So we are less concerned about that with regards to this kind of scenario. Okay, so that is why I did not bother myself on that. The next one. The next one. It said 1/4 of the expenses on rent was paid on the apartment occupied by the father of the managing director. And I was explaining that 1/4 is not allowable, and that needs to be disallowed, Abi. So if in these apartments they use electricity in the past, would have charged it, would have said 1/4 of it would also be disallowed. But now where there is prepaid meter, we can actually calculate what each flat used, right? But ordinarily, what you should have also done is that you take 1/4 of that electricity and disallow it. If they have to pay tenement rates, 1/4 of the tenement rates will be disallowed. Okay? But in this regard, there is nothing like that in this question. So we'll move on. So 1/4 of that will be disallowed. Next one is half of the advertisement cost was incurred on sponsorship of television program where airtime was allocated to the promotion of the product of the company. Is that an allowable deduction or non-allowable deduction? Sir, for companies with experts, mostly their expenses are borne by the company. In this case, will the expenses not? So the experts would have been treated as maybe consultant to you, okay? And you remember, we said the tax liability paid by them will be the final tax, the withholding tax paid on this type of expense, tax liability on the expenses of the, what's it called, of the recipients, which is the expatriates. Meanwhile, to the company will recognize that an expenses. Do you understand me? So the expenses is borne by the company and it is tax deductible on the part of the company. On the part of the expatriate will pay tax on it, but the tax the expatriate is paying will be 10% of the contract sum. And that will be the final tax liability from the expatriate. But the company will be allowed to deduct this as allowable expenses. Okay? I'm responding to someone that sent that chat. So in case you have any question, you can put the chat. Okay, Abiola. So the next one. Half of the advertisement cost was on sponsorship. Advertisement is allowed. Sales promotion is allowed. Okay. So the now also a population and entertainment of 3.1 million included the sum of 308 paid as sales commission to the agents is allowed. The next one. Cost of computer hardware, that is capital expenditure, 680K, not allowed. 520K, not allowed. Lubricants is stationary, it is allowed. So that means only capital expenditure there will not be an allowable deduction. The next one. The amounts incurred as gifts and donation include the following. Donation to Egba community for town hall development, not allowed. Donation to University College, Ibadan, that is allowed. Gift to gubernatorial candidate for electioneering, that is not allowed. So the only one that is allowed there is donation to University College of Ibadan. The next one. Subscription of staff to the Institute of General Accountants is allowed. Subscription to recognized trade association is allowed. Subscription to staff to Nigerian Institute of Management, that is also an allowable deduction. Those subscriptions are allowed. Capital allowance agreed is this. You are required to compute the company income tax. So you can take it one after the other. Now, in this kind of scenario, number one thing is you determine the relevance here. The relevance here in this question will be 2024. What is the name of the company? Fortune. Computation. of tax liabilities for 2024 year. So you start from the net profit because I don't want to adjust. Profit for the year. Profit for the year. Don't forget that this is in thousand. It's in thousand. So after profit for the year, we have add and deduct. Add and deduct. So we said profit on disposal is not allowed, is not taxable. So what do? We add back, we deduct 850. The next one, we said that one is not applicable to us. So rent. 4 of the rent. You go back to the body of the question. That is where you will see the rent value. Rent here is 2001. So multiply by 21. So if I multiply that, what would I have? I will have 525. It is not allowable. We add it back. The next one. We're told that half of the advertisement cost was for television adverts, where sponsorship or where time were allocated. That one is allowable. The next one is public relations and entertainment of 3,150, included the sum of 308 paid as commission to sales agents. That is allowed. We get to the next one, which is included in miscellaneous expenses are the following: cost of computer hardware, not allowed, 68, we add back. Furniture and fitting, how much? 550, we add back. We say printing and stationery allowed. Gifts, under the gift we have donation to Egba, that is not allowed, 360. Gubernatorial candidate, how much? 490, that is not also allowed. Subscription to ICAN, subscription to trade association, and subscription to NIM are allowed. After you are done with the additional information, you go back to the body of the question and start looking at the trial balance one after the other, profit and loss one after the other. Director remuneration, salary, rent, advertisements, they are all allowed. But depreciation is not allowed. How much? 650,000. Any other information? No other information. Other information that is not allowable there, no other information. Therefore, we now add all this together. Whatsoever answer that it gives us, whether the answer gives us negative or positive, we have to write it that way. And add it to this guy. So if the answer gave us negative, add the negative to this side. If it gives us positive, add the positive to this side. Okay? So let's see what you have. So that will now be whatsoever that you have here, we'll bring it here. Whatsoever side that gives to us, that's what we are going to adjust it. So we now have our adjusted profit. What do you have when you added it together?
13,000, 13,271. That's what I got.
That's
So
what
what
the
do you-
adjusted profit too. That's what adjusted profit.
What do you have here when you added everything here together?
2,405.
2405.
So you will now add it together with this. You have
13,271.
Okay. So because there is no loss relief in this question, we'll just go straight to our capital allowance.
Is the profit not 886? 10,886. It should be 12,291. 13,291. Yes.
13,291.
I got 13,271.
No, it is 13,291.
This
Net
is
profit is
this is
10,886.
this is 680.
The net profit by the account 10,886.
Okay, not 10,866. Okay.
Oh, 1088, Abby.
Yes, 10,886.
Okay. So is this correct? Let's go ahead. This is correct, right? What was our capital allowance?
13,291, not 27. Okay.
What was our capital allowance?
725,000.
The year, nothing. Relief for the year. 125. 725. Total profit. Oh yeah. Company income tax at 30%. Now, when you look at this question, the turnover is 100 million, so that's why we're using 30%. The turnover is less, we will not use 100%. Tertiary education tax at 3%. This tertiary education is on accessible profit. Meanwhile, this one is on total profit. So that's the end of the question. Excuse me. So whatsoever answer you got will be. So let's now look at another question. I'm coming. Okay, sorry guys, the network was bad. I just got in back. So sorry. I want to look at the year that we're going to quickly do. So that we'll do it and move on. If you have your past question with you, go to 2000 and okay, let's look at question number 1, 2004, 24. Question number 1, 2024. Sorry, there has been a lot of distraction today. I don't know why. I'm so sorry.
May or November 2024?
May.
Which year, sir? And which date?
May 2024.
Sorry, sir, please, can it be sent to the group?
Okay, someone should just download it and send it to the group, please. Okay. May 2024. So let's take it. Are we ready? Are we ready? Please respond so that we know that you are hearing me, please.
Yes, sir. Yes, sir.
Good. So, under examination condition, questions on company income tax is going to take like 3 or 4 pages. So, it is now less for you to be able to see what is correct and what is not needed for the exam. So we are going to look at this question and see the question pattern. How examiner likes setting question. Examiner will set the question in such a way that, like in the first page of the question, about 3/4 of that question, of that page, will just be story. And when you look at the one you have with you, you'll see that it's just full of stories. Examiner will write story, but that should not discourage you. You have to read it. So someone is helping us read that question so that I can be analyzing what you need to know there. You can see that in this question, a whole number 1 page, page 1, is for the introduction. Someone should read it for us, please.
Okay, I would read.
Thank you.
Soft Farm and Agro-alike Limited, a subsidiary
Number
of
1.
Emperor. Question
Sorry,
1.
I know. Number 1 thing that I just realized in this question now is that this question is on Soft Farm. And Soft Farm is an agro-allied business. Okay? Being an agro-allied business, what are the tax implications of you being an agro-allied business? Capital allowance.
Section not applicable.
Will not be restricted. You said something now?
No, I thought you asked the question, so that's
Okay. So what I am saying here is that it is an agro-allied business. Because it's an agro-allied business, what is very important to us is that you remember I told you for capital allowance computation purpose, you do not restrict capital allowance for manufacturing business and trading and agricultural business. So we are given an hint at the introduction of the question now, that this is a manufacturing company. So that means by implication, when you want to calculate capital allowance, you do not restrict the capital allowance. Okay, let's go.
Okay, so Soft Farm and Agro-Alike Limited, a subsidiary of Imperial Agro Incorporated, Italy, was incorporated in Nigeria in January 2018. Soft Farm and Agro-Alike Limited produces palm kernel for domestic use and export to the European markets. The managing director of the company has just received a letter from the head of his parent company of an impending visit occasioned by poor business performance below the group's return on investment benchmark of 25% since
Let's pause there.
commencement of the business.
Let's pause there. You did talk about Schedule 7 last week. Schedule 7 is saying that interest or loan, what's wrong with this thing? Interest on loan from subsidiary or foreign partners or third party shall not be more than 30% of the company's, are you following? Earning before interest, tax, depreciation, and amortization. Are you getting that it shall not be more than 30% of company's earnings before interest, tax, depreciation, and amortization? Okay, so where it is more than 30% of EBITDA, then the excess shall be carried forward for a maximum period of 5 years. Okay, so the excess shall be carried forward for a maximum period of 5 years. So that is that. Now, this question is bringing in that dimension of interest. That's why I clearly have to go to this place. It's bringing the dimension of interest into this question because you, as Soft Farm Limited, has gone to your subsidiary or to your parent company to ask for loan. Okay, that means we have to check if that loan is not more than 30% of the interest before earnings before interest, depreciation, and amortization. So let's go ahead. Read on, please.
Okay. In spite of financial and technical supports rendered by the parent company, so it will be recalled that in January 2022, the parent company granted a loan request of 100 million to Soft Farm and Agro-Alike Limited for business expansion. The board has scheduled a special meeting for next month for the consideration of the financial report of Soft Farm and Agro-Alike Limited for the year ended December 31st, 2022, a review of past financial reports and tax assessments. As the newly engaged tax consultants to the company, you have been invited to be part of the meeting for the purpose of providing professional opinion on tax-related issues that may arise. To help you prepare adequately for the meeting, The financial accountant has been directed by the managing director to make available to you the financial statements for all the periods under review, books of accounts, returns filed, and tax authorities, and other supporting documents. You noted from the preliminary review of the financial report for the year ended December 31st, 2022, an item that requires further discussions with management of the company. This issue is in respect of interest paid on loan obtained from the parent company.
Full stop.
Extra. Full stop here.
Now, when you look at that, you will notice that the examiner is tending towards interest on loan. He wants to ask question on that. That's why the guy is moving towards that direction. Okay, let's go ahead.
Okay, extract from the financial statements for the year ended 31st December 2022 reveals. So we have the gross turnover, such as domestic sales, export sales, other operating income, and the total gross turnover. Then the deducts are staff salary, ground rent paid to the state government, motor running expenses, audit and accountancy fees, repairs and maintenance, depreciation of assets, rent paid, power and lighting, legal costs, rates, allowance for doubtful debts, donations, interest and other finance costs paid, income tax provision, and general expenses. And our net profit is 104,560,000. The following additional information is available. We have export sales. 20% of the export sales was made to the parent company at the prevailing international market price. We have operating income, other operating income
Before we move ahead, what is the implication of these statements at the prevailing international market price? What are you trying to avoid? What is the implication of that statement?
To ensure the transaction is at arm's length.
Arm's length.
Arm's length. Okay. And to also ensure that there is no transfer pricing between the two of them. Okay. And arm's length principle will be tested. Now, the arm's length in this situation is that you have sold the goods to them at prevailing market price at no extra profit or at no reduced cost. Okay? Yeah, because if we are together in an organization, I can decide to sell for you at a lesser price. That means if I would have sold this to a third party for 100,000, I can sell to you 80,000. So that means the profit that the government is supposed to have charged has not been really fully accounted for. In that regard, it should be disallowed, and the excess will be subject to tax again. So in this regard, this guy is able to ensure that any form of transaction that is not at arm's length was taken out. Okay, let's go ahead.
Okay, so other operating income are dividend received and profit from disposal of non-current assets.
Which is 3.3 million.
3.3 million, yeah.
You
Repairs
remember
and maintenance.
wait, my baby, what's your name?
Ibukun.
Ibukoloa. Okay. You remember in my last class, I taught you minimum tax. Abi? Even if examiner did not ask you to compute minimum tax, you are going to check for minimum tax. And minimum tax is calculated on gross turnover. And we talked about what gross turnover means in my last class with you. And I know that you guys still remember. Gross turnover could include dividend, rent, interest received, royalty received, sales from the ordinary course of the business. Other income. So this is the definition of your turnover. Okay. So that means if you are given any question under examination condition, you must check for minimum tax. If you have compared your company income tax, you also need to check minimum tax. You remember, we said minimum tax will arise where the minimum tax is more than the company income tax computed, where minimum tax is greater than company income tax, then minimum tax will be applicable. Okay, so that is that. You need to always check for all those. You don't just read and move on. You read it, you look at it, and you analyze the possible implication of the tax principle that the examiner is trying to talk about. Let's move on.
The third
Next.
one, repairs and maintenance. We have repairs of plantation equipment. We have repairs to premises, non-industrial building, expansion to warehouse, industrial building, and the
Before you
total
go
is
ahead.
5.8 million.
Good. So let's go back to the second one, that other income. For the purpose of company's income tax, dividend received, whether it is net or gross, is not taxable. Again, this question, profit on disposal of fixed assets is not taxable. So that is that. You have to be very careful when you are doing that. So we are moving on. The next one now is repairs and maintenance. Repairs is an liable reduction. But in the case of expansion, it is capital in nature. Therefore, it is not going to be allowed. However, on that asset, on that expansion rather, on that expansion, capital allowance will be computed. Do you understand? So that is that. We'll move on to the next one.
Next, rent paid. This is in respect of accommodation for the newly employed general manager, whose basic salary is 4.8 million.
Is allowable, right?
Yeah.
Next.
Legal cost. Cost of income tax appeal, cost of debt collection, cost of acquiring new lease, renewal of old assets.
Okay.
We have 5 million.
Before we go ahead, the confusion in this question. Okay. Cost of income tax appeal, not allowed. Tax appeal, not allowed. That's number 2. Cost of debt collection, allowed. Cost of acquiring new lease, not allowed. Cost of acquiring new lease, not allowed. Again, renewal of old lease. We do not know whether this lease is a short-term lease or long-term lease. Therefore, our advice to the examiner in that year when we were providing solution was to tell the examiner that since there is also like old lease, anybody that treated this as disallowable, the person will get the answer. Anyone that treats it as allowable, the person will also get the answer. Because we do not know whether it is a short-term lease or a long-term lease. So the students are at liberty in that regard to treat it in the way they deem fit. Okay? So that is that. For me, I'm going to disallow it. That's right.
Allowance for doubtful debts. We have specific provisions, general provisions, and bad debts recovered. Total is 10.5 million.
Which one is not allowed there?
I'm not allowed.
Which one?
General provision.
General is not allowed. You can see that you know all this thing. We move on to the next one.
Donations. All Research Institute, National Library, Poco Research Institute of Nigeria, Women at Society of the Host Company, Community.
Which one is allowed? Which one is not allowed?
Women's Society is not allowed.
It's not allowed.
Yes. So someone wants to go back again on that list. Let's talk about list. List. For tax purpose is divided into two. We have the short term and the long term list. Acquisition. Acquisition of short term list or long term list are not allowed. Renewal. Short-term list allowed. Long-term list not allowed. So this is our guiding principle for leases. Unfortunately, under this exam, the examiner had included new lease, acquisition of new lease, renewal of old lease. Firstly, there is nothing like old lease and new lease. But this can be understandable where we say what this examiner is talking about here is they have acquired lease, and we know that acquisition of lease is not allowed. But when it comes to renewal of lease, you have to actually specify whether it is a long-term lease or a short-term lease. But this examiner failed to specify, and now putting students in the dilemma of where to follow, whether they should take this direction or take the other direction. In that regard, I now said a student could say, I am assuming this is a short-term lease. Therefore, I allow it. Because in our center, they said short-term renewal of lease, allow it. And now will come and say, no, I am taking this as long-term lease. For the long-term lease, I am not going to allow this. So it is not allowed. Okay? We say it's not allowed. So, and I said, student could say, this is my own direction. And I will say, this is my own direction. So either ways will be correct under examination condition because the examiner had failed to identify or to go in the direction that is correct. So that is the issue. Any question? Thank you. The next one is interest and other finance costs paid. Go ahead.
Interest and other finance costs paid. In January 2022, the company obtained a loan facility of 100 million from the parent company for the purpose of expansion of the business at a competitive interest rate of 12% per annum. The duration of the facility is 10 years. The company is expected to pay interest due for the first 3 years, while from years 4 to 10, both principal and interest dues are to be paid at the end of each year. The balance as shown in the financial statement is attributed to other finance costs and bank charges paid to domestic deposit money banks on various accounts operated by the company.
Okay. Before we go ahead, let's calculate let's check our interest from bank is at 12%. 12% per annum, isn't it? How much did we collect? We collected 100 million. And the annual rate will be 12%. Therefore, we have 12 million as our interest on loan. Okay? 12 million as our interest on loan, which is allowable. Now, they now said, included in the interest stated in this, our financial statement, we have this 12 million and the balance. So total interest in the financial statement is 15 million. Less interest of 12 million. The difference is 3.6 million. This 3.6 million is the interest from other domestic bank. Abi? Interest from other domestic Abi? So, but we are not so sure if this interest, which is this guy, is more than the 30% of our earnings before interest, tax, depreciation, and amortization. So let's go and check. What's our earnings before interest, depreciation, tax, and amortization? How do we go about that? What's our net profit? My net profit in this question is 10. How much is my interest? How much is my interest? My interest is 15,600. My depreciation how sorry guys. Can you hear me?
Yes.
I don't know what's wrong with this one. Though. Wow. I'm coming. Where's my former cupboard? Oh, oh, see what's still that. Oh, okay. I can't actually sit down. I don't know why. But let's just continue. So, you remember where we stopped now? Let's calculate our earnings before interest, tax, depreciation, and amortization now. So, on that one, we have net profit. Our net profit is 104,560. Add interest back 15,600. Add income tax which is 23,400. Add depreciation back, which is 38,040. Right? Any other information? We get our end before interest tax depreciation. Maximum allowable is 30% of our EBT. So this maximum shall be compared with the actual interest. Okay, so our actual interest on loan is actually 12 million plus our 36, 15,600, right? So 30% of what do you have here?
77,240.
Back, what do you have?
181,800.
So 30% of that is what?
54,540.
Okay. Now that is 1,800. You have 54,540. Maximum is the lower of the two. Lower of the interest, 30% of EBITDA. So lower of these two is this. So that means we do not need to restrict this 15 million. Okay? We do not need to restrict it. That's what I just want to show you. We move on. In this question,
Sorry, sister, how did we get 36? Like 12,000 plus 36?
that was my last board now. That board that deleted. You now got 12,000.
Yes, that's the interest.
So on the body of the question, the total interest there is how much?
The interest is 15,600.
15,600. So this is very related to other finance costs and bank charges paid to the mesh. So that's how we got. That is 15,600,000 minus 12 million. You will get that 36. Okay. So we'll move on.
Sorry, sir. So what we're comparing with 30% of EBITDA is the total interest and not just
Yes. Yes. Read the schedule 7 that I gave you. It's in your study pack. The one I sent to you is there.
Okay.
So you will see it's not only this interest. We talk about interest that encompasses a lot of things, not only this. The examiner only considered the 12%, the 12 million, which is wrong.
Okay. Thank you, sir.
Yeah. So let's go ahead. The next one is general expenses.
General expenses. We have wedding gifts to staff, fine imposed on company's driver for traffic offense, college expenses, transport and traveling, 5.9 million.
Big gift not allowed.
Excuse me, sir.
Wedding gift is not allowed.
Fine. Is not allowed.
Hello, sir.
Yes. I'm with you.
Okay, so what do we do with this lower of interest and the 30% that we calculated up there?
You allow the lower of the two. The balance, this is the total interest that is allowable. But what we are saying, there is no balance here now, because the act is saying we can give you up to this, but this is what you are. So it's more or less like someone is saying that your interest should not be more than 100,000 that I'm going to allow. But at the end of the day, when you calculate it, you add 80,000. So there is no restriction. But let's assume that your interest, the maximum you can claim is 100,000, but you have 150. Therefore, the balance will be carried forward. So in this scenario, I said the maximum I can give you is this 54.5 million. But you ended up having 15.6. That means there is no restriction. I'm not going to restrict anything. Do you understand me?
Yes, sir. Thank
Good. All right, let's move ahead. If you are there, I'm there.
Okay.
Are we ready? Yes, go ahead.
Yes. The next one, schedule of prior year's turnover and accessible profits.
This
We
examiner,
have
wait, my dear. This examiner means you guys. The examiner went back to give you schedule of turnover from 2018 to 2021. The implication of that is that the examiner wants to calculate the tax liability for all the relevant years. Let's go ahead.
So we have 2018 to 2021, the turnover and the accessible profits.
Mm-hmm.
The next one, or should I read them out?
The next one is qualifying capital expenditure.
Yes. Okay. Qualifying capital expenditure. We have the date of acquisition, the asset type, and the amount.
Good.
Oh,
As a tax consultant,
as
to
a
the
tax
company,
consultant to the company, you have to draft a report to the managing director of Soft Farm and Agro-Allied Limited, in line with the provisions of the Company Income Tax Act, Cap C21, LFN 2004, as amended. The report should provide professional advice on the A. Treatment of excess amount of deductible interest paid. B. Adjusted profit of the company for the year ended December 31st, 2022. And C. Tax liability for all the relevant assessment years. 30 marks.
yes, you can see that this examiner is whining you. They say you should write reports. Apart from your calculation, your report will now, apart from calculation, your report will consist the treatment of excess amount of deductible interest paid, adjusted profit for the year, and tax liability for all the relevant years. So you have to write your report in that direction. You need to make your calculation and also write report to substantiate that. So the first thing I'm going to do here, what class do you have after this class?
you. Case study.
Case study.
Case study. What time?
10:30.
Okay. So the first thing I will do is that I'll first calculate my capital allowance. I will say computation or preparation of assets allocation schedule. Now, the relevant year of this company is from 2021, 2018 rather, to 2022 year of assessment. Isn't it? So 2023 year of assessment. How do I know? How do I know that it's from 2019? The first profit that I was given started from 2000 and what was it called? 18. And the examiner wrote year ended. So that means I would have to take it from that year. And this question is not commencement. That means they have been operating for so many years. What is the accounting year end of this company? The accounting year end of this company is 31st December annually. So from 2019 to 2023 years of assessment. You remember we said we have tax year, ages period, and QC 2019. Your base will be 1-1 because the accounting year end of this company is what? 31st December. Abi? That's the accounting year end. Okay. Now, for the purpose of this, because the company is not just starting operation, my capital allowance, I would have to start from 2018 year of assessment because of the capital allowance that I have. So I would say from 2018 to 2019 year of assessment, 2023 year of assessment for my capital allowance computation. So in my 2018, I would have 1/1/2017 to 31st/12/2017. In 2019, I will have 1/1/2018 to 31st/12/18. From 2020, I will have 1/1/2019 to 31st/12/2019. 2021, I will have 1/1/2020 to 31st/12/2020. 2021, I will have 1/1/2021 to 31st/12/2021. The next one, 2023, I will have 1/1/2022 to 31st/12/2022. Now, I will now look at the asset I was given. Now, the first asset, the first two assets in the question will fall within this period, isn't it? So, which is plant and equipment, right? And industrial building will fall in that period, right? The next one, even non-industrial building, will fall in that period. The next one was in 2018, motor vehicle. Abi? The next one is furniture and fitting. It will fall in that period, furniture and fitting. The next one in 2021. In 2021, we acquired motor vehicle again, motor vehicle. And in 2022, we acquired research and development and plant and machinery, furniture and equipment, and also research and development. Remember, when we were reading the question the other time, there was an expansion to building. Expansion somewhere. Number 3, under the repairs and maintenance, expansion. That will be treated as addition. So expansion. That your expansion will be the industrial building. So this is your schedule for your capital allowance. Do you understand? This is your schedule for capital allowance. Now, we need to calculate the examiner here had made a significant error too. by starting from 2018. Okay, no, 2018 is the correct year to start. Okay, so we'll have to calculate our what was it called? Our capital allowance for those periods. So we'll say, I'm just going to do the first few capital allowance and we'll meet again next class. What is the name of this company? Soft Farm. Computation of capital allowance for 2018 to 2023 years of assessment. How many assets do we have? We have plant and machinery. We have industrial building. We have non-industrial building. We have motor vehicle. We have furniture. We have furniture. And we have research and development. I don't know our capital allowance. So I'll say my QC, the first one is plant and equipment. Next one is industrial building. Next one is non-industrial building. Next one is motor vehicle. Next one is furniture and fitting. And the last one is research and development. And this will be capital allowance. In 2018, I bought 2 assets. I bought 3. Is it 3? Let's go. I bought 2. I bought 2. So if you are looking at the past question now, examiner had made a significant error in bringing furniture and fitting and motor vehicle to 2018 year of assessment. It's not supposed to be there. It's supposed to be in 2019 year of assessment. Do you understand the reason? So this is your table that is guiding you. And where they acquire the asset, you have introduced them appropriately. Do you understand? So for what is it called? Plant and equipment is 50-25, 15-10, 15-10. That is the rate. This is 50-25. This is 25-20. This is 95% for initial allowance, dash for annual allowance. All this will be given to you in the exam, so don't cram it. What is my cost of equipment? 4.6 million. What is the cost of industrial building? 12 million. What is the cost of non-industrial building? 900,000, 9 million. No other asset acquired that year. In this year, it should be 2-3, that is 50% of this. 15% of this is what? 1,008. 10% of 9,000. 1350. No other asset in that year. We add all together. What do we have? Are you seeing this last? Hello?
5,450.
What do you have?
5,450.
Okay. The next one, annual allowance. You know how to calculate your annual allowance now. Annual allowance is equal to cost minus initial allowance divided by N. So for annual allowance for plant and equipment, it is going to be 4.6 minus 2, 3. How many years will this use? It will use 4 years. Same for industrial building. That will be 12 million minus 1.8. How many years? 10 years. Same for non-industrial building. 9 million minus 1,350. 10 years. Whatever you have, you bring it. What is the answer? What do you have? What do you have? What do you have now? Are you in this class at all? Hello? Are you guys tired?
So for
No.
first one, we
You're
have
not responding.
575.
What do you have?
575
575.
arms and equipment.
What about this?
I have a
1,020.
question, sir.
Yes.
This first item of QC, plantation equipment. So are you going to take it?
If
Plantation
it is
equipment.
plantation, I didn't see that it's plantation equipment. I thought it's plant and equipment.
Okay.
Plantation equipment is 95%.
Okay.
Do you understand? I didn't see it as that. Sorry about that.
Okay.
Do you understand the question?
Yeah, so that means the rate we have to change, right?
Yes. This is 95 dash. There won't be annual allowance for that. So, yeah, give me, what do you have? What's my value?
At 4,370.
Okay. So this is not correct.
$7,520.
Okay. AA. This guy will not have AA. This guy has AA. This is true. What do you have?
1,020 for industrial building.
What about this?
$815.
Add the two together.
$1,835.
Are you sure this is correct?
Which one?
This one is not correct though. 9,000 minus 1,350 divided by 10.
Oh, 765, sorry. I think I fixed that at 8,000.
So what do you have?
1785.
One 785. Add to the what do you have?
9,305.
What do you have?
9305.
No. Are you adding this to?
Yes.
9305.
305.
Okay. 9305. Thank you.
Yes, sir.
Yes.
Yes. Are we using 4 months or 5 months for this annual allowance?
100%. Why are you using 4 months? I told you that whenever you have a full basis period, you are not prorating the annual allowance. Because this company is not just starting operation, they've been in existence for so long.
Okay.
Good.
Thank you.
What's your tax now value for this guy?
230.
What about this guy?
9,180.
How about this guy?
6,885.
Did we acquire any assets this year? Yes. We acquired, look at it though. In 2018, we acquired motor vehicle and furniture. So, addition. How much is the motor vehicle that was acquired?
6,400.
8,000.
400.
What about the other one?
1,500.
On that one, you calculate initial allowance. It should be 4,200. 1,500 abi? So 25% of 1,500. What do you have? If you add these two together, what do you have? That is 4,575, right? 4,575. No allowance. There is
What
no.
is for the motor vehicle? Is it 50? What do you have there? 50, right?
So annual allowance. I bring my annual allowance. I will need to calculate annual allowance for motor vehicle. That will be 8.4 minus 42 divided by 4 years. That will be 1050. And the same thing for this one, but this guy is going to be divided by 5 years. That is 1,005 minus 375 divided by 5 years. And we have 225. Add it together across. What do you have? Hope you are following me. Give me my answer, please.
3060.
What do you have? What do you have?
3,060.
360.
3060, yes.
Add it together. What do you have?
7635.
7. Hope you are just listening now. The next one, 2020. Tax free now value. Tax free now value. What is my tax free now value 2020? 230 for this guy. What is for this guy? What is for this guy? For this one.
8160.
This guy. This guy. Kelvin, what is your question? Kelvin, your question, please.
Evening, sir. It's time for case study class.
Started from?
It's time for case study class.
It's time for case study class. Okay, okay. Let me just quickly round up. What about this guy?
900.
On this one, I'll calculate my annual allowance again. Annual allowance is constant. But before that, they acquire any assets this year. Let's check. You go back to your table. None. None. So I can go ahead. None for this year too. None. So we have 3060. 2021. 230. What would I have for this? 7140. This guy, 5355. What would I have for this guy? 21. What would I have for this guy?
675.
On that one, calculate my annual allowance. Annual allowance. There is no annual allowance for this. There is annual allowance here. Annual allowance here. There is annual allowance here. There is annual allowance here. Okay. So I'll see how the same. But in 2022, there was addition. But before that, let's get this 6120. This is 4950. This is 10. This is
450.
450. There is addition in 2022. Motor vehicle. Bought motor vehicle again. How much motor vehicle that was bought? 56. Abi?
Yes, 56.
On this new one that was bought, did they buy any other thing that year? Nothing. On this new one that was bought, we calculate our initial allowance. That is 50% of that. We have this. AA dash A for this guy is constant. A here is constant. This is the last year of use of this guy, of the old asset. I must retain 10 naira. And I will also calculate for the new assets. Okay? So the new asset is cost minus initial allowance divided by 4. What do you have? That is 700. Abi? That is 700. Don't forget that the old asset is having a terminal value of this. But we're told that that asset we bought 3. That means I remove 30 naira, 10 naira per one. I will have 1,049,970. Abi? On the new one, new assets, I would have 5628 divided by 4.
So
Find yourself. Now, you remember when we were doing capital allowance, I told you in the last year of use, your AA will be taking now value of the previous year minus 10 naira. This used to be our formula. That's when we get to the last year of use, you must retain 10 naira. And meanwhile, this asset has gone to the last year of use. How do we know? Year 1 is supposed to use 4 years. Year 2, year 3, year 4. In the year 4, you must retain 10 naira. Abi? So retaining 10 naira will now, because we know that we have taken this one in 1,000. That's why we brought it out here to calculate. So the old assets would have a tax now value of 1,050. But don't forget that other old assets, we acquired 3 of them, not only 1. So that 3 that we acquired, we need to remove the value, the nominal value of that 3 assets, which is 10 naira per asset. So that would be 30 naira to get this. On the new asset that we acquired, we will say 56, that is 5.6 million minus 2.8 million divided by 4 years. That will give us 700. I add the two together, I will have 1,749,970. Abi? So I'll come here. I cannot take everything, I will have to approximate. Abi? That will be 1,074,000. I can just say 750. 750. But you understand what I did? I just divide this one by 1,000 to get this value. On these old assets, I'll still continue. What is my annual allowance on that? We have 225. Do we have anyone? Yeah, what's the calculation? In 2023, terminal value 230. What's terminal value of this? What's terminal value? Give me one.
5,100.
5,100. Abi? One, two,
4185.
485.
Yes.
What about this? Addition. The addition, nothing. You remember, there is an expansion to this guy. The expansion was 37. What
Yeah,
we're
it's not
talking about,
supposed to be. They're
oh,
not
yeah.
supposed to be in jacket too. The
Which one?
5-6. The 5-6 is not supposed to. The 5 is not supposed to be in bracket too.
No, it's not supposed to be. So what do you have? What do you have?
2,100.
True one. I want us to finish this capital allowance so that when we come in the next class, we know that we are done with capital allowance. Please note all these numbers because we are going to use them. So what do you have on this? Will be 700. This asset too. How many they acquire when they acquire the furniture and fitting? The furniture and fitting then, how many was acquired? The first one. They said they acquired 10. Abi?
Yes, 10.
So 10. The same thing. But before 10, they said they acquire additional one this year, which is 2,000. The old asset, that's the last year of use. And this will also calculate that. I will say 225 minus 100. Abi? Why is it 100? 10 assets. 10 times 10, 100. We have 2, 2, 4, 9, 100. Abi? The next one. The new asset, old. New asset. They acquired that new asset for 2,000. On that new asset, I will calculate my initial allowance first. 15% of 2,000. That will be how much? 300. Abi? Now, I know that I will have this as my computation of my annual allowance. 2 million minus 300.
Mr. Chris.
Yes.
Good afternoon.
Good morning.
We're supposed to start another class now. And
are you using this link?
Yes, we cannot start another class if you don't end this class. This class is supposed to end by 10:30. And case study is supposed to start by 10:30 immediately.
Let's finish this one. Okay. So this will be 270. Abi? No, it's not 270. You have distracted me. This will be divided by 5. That is furniture and fitting. Divided by 5. So this minus this 17. 17 divided by 5. What is that? $340. I add this together plus 22.224.9. And we have 564.9. So we can say nice. Do you understand? You can actually say we can say 5, 6, This is 5, 5, 5. What do you have?
564.9.
But when we want to write it, we can write 565. Are we? So we acquired also this year. What is my annual allowance? Initial allowance on this new addition. That will be 15% of that 3.7. That expansion that we have, 15% of it, what do we have? 37 multiplied by 0.15, 555. So 555 plus, that will be 855. Now, on this, I also need to calculate my initial allowance. Sorry, my annual allowance on the new one. 37 minus 555 divided by 10 years. Abi? 37 minus 555. That will be 314.5. I can actually change this to 315 plus 10,000 divided by 10 plus the initial allowance, that the first allowance that we have been carrying forward is 10,200, 1020. So I'll just say 1020 plus 315. I will have 1335. On the old one, 765. On this one, there is no initial allowance. My annual allowance is 700. So I also acquired research and development. Research and development I was acquired was 7 million. I'll bring that in addition. 7 million. 95% of the 7 million is my initial allowance. What is 95% of that? That will be 6650. So if I add all together, I will have 7705 for all the initial allowance. All the annual allowance will be added together by you. You get the answer. I think the class is over, but you guys are not answering again. So we'll see again in our next class. Good day to you.
Thank you.
All right.
Thank you, sir.